Today, we're talking all about gift cards with the purchase and sale of a small business. In some industries, this is really important to make sure you get it right. Check it out.
I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium sized businesses while controlling risk. So, if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So be sure to hit like and be sure to hit subscribe, and let's get to it. Are you thinking of growing your business or beginning a journey into entrepreneurship? Take a shortcut to success by buying an existing and profitable business the right way. Visit businessbuyeradvantage.com and learn more about my online training, group coaching, and consulting services designed to help you win.
All right, I've talked about gift cards before in past videos, but recently I've had quite a few conversations with different clients, both buyers and sellers, about gift cards and how it affects the value of the business or how it gets dealt with in the sale. And I thought it would be an interesting video to make for all of you here today. And so, very first thing we're going to do though is we're going to talk about what exactly happens from an accounting point of view when a small business sells a gift card. Because if you're going to buy a business that has gift cards, you got to understand what the business has been doing with respect to how they record the sale of gift cards and where the money goes and how it's treated on the financial statements, or else you could be looking at some information that is really erroneous. So let's take a look. This is the sample company from the dividends SDE question that I did a couple weeks ago. And so in the income statement here, we've got sales, cost of goods, gross profit, all of the expenses over here. We've also got down at the bottom, I've got the add backs, and the SDE calculation on this business is $333,000, which is not really going to be a big part of this conversation, but I wanted to show you that it's there and where it came from. And so when we record a sale in a business, it's because somebody shows up at a business and they give us money and we give them a product or a service, right? So that's when we record the sale. And we also record the cost of goods sold to deliver that sale. And so this is when inventory would go down and we would record an expense related to the cost of the item we sold to that person. Okay. So that's recognizing the sale. In the case of a business to business sort of business, then it might be the sale is recorded when the product is delivered to the customer, and that's when we then create an account receivable, right? Because the invoice was issued at that moment. And so you want to ask the question, if there's gift cards in a business, you want to ask the seller, what happens when you sell a gift card? How do you record that in your accounting software? Because you will find some small business people will record it as a sale, right? And so if that is the case, then their sales have been overinflated in the prior periods by the amount of the gift cards they've sold, because they've recorded, for example, a $100 sale, but they've got no costs for any of the labor or materials that went into delivering that sale. And so if you bought this business, you wouldn't necessarily know how many gift cards are outstanding. There'd be a lot of gray areas and dark spots that you'd have to navigate. But more importantly, the performance of the business in prior periods would be exaggerated. Okay. So you'd have to try to figure out what the gift card sales were, how much are outstanding, and then you'd have to figure out, to which years those sales belong to try to normalize the sales back to what they really were. So if selling a gift card is not making a sale, then what is it? Well, let's think about it. Somebody shows up at the front counter of a retail store and they hand over $100 in cash, and what do they get back? They get a little piece of plastic or a paper certificate or cardboard, certificate that says this is good for whether it's $100 of free services or a massage or something like that. What we are doing is we're trading cash today for a promise to provide a product or service in the future, right? And so this is exactly like when a bank lends a business $100 in exchange for a promise to pay back the bank the $100 in the future. plus interest. So, so what's happening then when you sell a gift card? Let me expand this. Um, when you take in the $100, you have an asset. Here, I'm gonna make this a little bit bigger. Maybe I can make it bigger just one more. There we go. So here's the balance sheet. So when I bring in $1,000, let's say, of cash, you can see my total assets have gone up by $1,000. I have to make a balancing entry, and the balancing entry is that I owe $1,000 of product or service to my customers. So when you sell a gift card, you are making a loan. You're taking a loan from your customer base, right? And the customers, literally, the gift card for $100 is a debt instrument for $100. It's almost like you've issued a bond for your company, and the customers are now trading those amongst themselves, right? So I buy a $100 gift card, I give it to my daughter, for example, and now she's going to go redeem that claim on the business. Okay. So from the point of view of borrowing or raising capital in your business, selling gift cards is fantastic, right? Because the consumers rarely do any degree of underwriting, like they don't ask to see your financial statements, they don't charge any interest, and on top of it, a certain percentage of these people are going to lose the gift cards, right? So selling gift cards is obviously a fantastic idea, and that's why people like to do it. Business owners like to do it, particularly in certain industries. Retail, trade, services, hair salons, aesthetics. Even major retailers. So if they are not recording it as a sale, the next question you want to ask is, where does the money go? Okay. Because in certain scenarios, the money is sequestered. For example, if you are buying a business that is part of a franchise chain, think about a franchise chain like a restaurant that has branches all across the country. Somebody could buy a gift card in one town, put the gift card into a Christmas card, mail it across the country, and it's opened by another person who then uses the gift card in a completely different part of the country. So, in a lot of franchise networks, when you go and you buy a gift card, the money doesn't stay with the local business. It goes up into the franchisor. They put it into a separate bank account, and that money is then used to for the redemption of the gift cards across the network, right? So, if that's the scenario, you don't really need to worry about this stuff at all because those gift cards are going to come in the day after you buy the business, and the money is going to be sent to you by the franchisor through the redemption of the gift card. Okay. Where this becomes tricky is when the small business owner sells gift cards and keeps the cash. Because what'll happen is as this liability grows over time, so let's say it's $100,000 worth of gift cards and a $100,000 liability, and you decide you want to go buy this business, what'll happen is you need to figure out what's going to happen with those gift cards. So there are a couple of different things that sellers will quite commonly say about gift cards. And I'm going to go through them. There's four of these items. So they will say gift card balances are always the same. So they will say that, for years and years and years, we've been selling gift cards, but we've also been redeeming gift cards. And every year, the outstanding gift cards are approximately the same. So you should buy this business and we don't need to worry about the gift cards. Okay, that's one thing I've heard. Another thing I've heard is that um, I was the one who actually did the marketing and advertising and bore the expense of making the gift card sales. So some part of the gift card money should stay with me because I undertook the effort to bring it in. That's another thing I hear. Another thing I hear is that I price things to encourage more spending. So, for example, all of the massages are $139, but I only sell $100 gift cards. So when people come in with the $100 gift card, they still have to pay an extra $39. And the $39 covers the cost of the person that gives the massage. So there's, really, there's no cost to you if I keep all the gift card money. That's another thing I've heard. And then I've heard about shrinkage. So people will say, on average, a certain percentage of gift cards are never redeemed. And so this is a reason why I should keep part of the gift card money. So what do I mean by keep part of the gift card money? Well, If we assume that this business has a value of 2.3 times STE, then according to the add backs and everything from this example, this business has a value of $766,000. And a lot of small businesses are sold on an asset sale basis, meaning that the operating capital is kept back by the seller, and the buyer brings their own operating capital. Now, I've made other videos about net normal position and working capital. There's a whole module in Business Buyer Advantage about it. Um, and so operating capital is a more complex issue, but for the purpose of gift card explanation, we're going to keep it rather simple. So if that were the case, then what would happen is if you are going to buy this business and you are going to carry the liability that $100,000 worth of gift cards could come in and be redeemed, then what you might say is one of two different things. Either we are going to settle the gift card liability on closing day, or we're going to settle it over time based on actual redemptions. So you might say to the seller, because I bear $100,000 worth of liability for delivering all of the services to people in the future, I want you to take $100,000 off the purchase price. And most sellers will not agree to this, right? Why? Because of the things I just mentioned. They'll say, wait a minute, you're not going to get $100,000 worth of gift cards because 20% of them are always lost. Or no, it's only going to cost you $30,000 to service $100,000 worth of sales. So I want to keep part of it. Basically, the cash has been generated and the sellers want to hang on to the cash. It's this constant thing that I see with business owners where they think, I want to sell the business and I want to keep the cash. They're looking for ways to have the total net realized value of the transaction add up to the biggest possible number that they can. And they come up with all kinds of different rationalizations often to try to explain away why this is okay. So, for example, um, and this is an example from a video years ago. There was a motel that was sold, and the motel owners had a small restaurant in the motel, and they had a contract to sell the motel, and they used a real estate agent. So the contract only talked about the real estate and just said, motel with a restaurant. So they had a deal to sell the business, the motel, I guess, on January. And so in the lead up to the sale, what the business owners did is they sold $100 gift cards for $80 each. And they sold thousands of dollars worth. And they pocketed all the money. And then they sold the business. And then in January, the new owners were there in the restaurant and people started to show up with these $100 gift cards. So what do you think happened? Right? Like quite literally, people lent $100 to the seller of the business, and the seller of the business took the money and ran and was leaving the buyer to deliver $100 worth of food without any of the benefit of the cash that was collected in advance. So when I term it in that way, you can see pretty clearly the kind of like why you need to deal with this liability, right? The sellers of that particular motel, I don't know who they are. I was brought in by the buyer's lawyer to comment on the situation. And my comment was that the intermediary never addressed operating capital or anything to do with operating capital in the contract, and the intermediary was completely incompetent, right? And so it was terrible. Went to court. Insurance companies were involved. Like, but in the meantime, the buyer ended up honoring those gift cards because otherwise they would have destroyed the goodwill of the business and the community, which is exactly what they were trying to buy when they bought the motel with the restaurant, right? And so the relationship between the business and the customers that hold the gift cards is of paramount importance to the buyer, right? So let's get back on track here. So I said there's two ways to deal with this. You either settle at the point of closing where the buyer accepts the liability and some kind of adjustment is made, or you settle over time. So what does settling over time mean? Well, in this case that I'm showing you here on the screen, these sellers have accumulated $100,000 in cash and there's $100,000 outstanding. So if you bought this business and there was a seller financing note, for example, what you could agree to if you could create a differentiation between the issued gift cards and any new gift cards. You could say, all right, Mr. Seller, I want you to finance $200,000, excuse me, of this sale. And anytime I accept a $100 gift card from the public, I will then use that as part of the payment for you. So if you owe this person, $3,000 a month in a seller note payment and you collect three of these gift cards worth $100 each, then you only write a check for 2,700 and you include those three gift cards. You say, look, I just delivered $300 worth of service that you collected on. And so you already got the cash. And so now I get to basically claw back. And so what happens in that scenario over time is the seller gets the benefit of any shrinkage, right? Because over the course of the next few years, maybe I only claim back $80,000 worth of gift cards. The other 20,000 stays with the seller. So as a buyer of the business, I get to enjoy all the profitability of all the customer relationships going forward in the future, which I should because I'm paying for the business to enjoy future cash flows, right? So in my mind, that's one of the sort of clearest, easiest ways to handle this gift card liability issue. Because then, if there is any, extra benefit from having done gift cards, the seller can take advantage of it, but the buyer doesn't suffer because the buyer still gets the full cash flow of the business that they're buying. But many sellers don't want to do that. Many sellers want a final clear cut solution at the point of sale. And so what they'll do is they'll say, listen, how about this? If we know that 20% of gift cards are lost, then how about I keep the cash, I'll pay off my payables and my credit card bills, etc. You accept this $100,000 gift card liability, but I'll knock $80,000 off the price, right? And so that's an example of settling it on closing day. So now the buyer's accepting the risk that more than 80% of the gift cards do get redeemed, but we don't have this constant accounting over the course of time, right? So some people would argue this is a simpler way to put a bow on the deal. Some of the other things I mentioned that sellers might say. I'll give you an example from a recent case. So in a recent case, it looked more like this. There were like $900,000 worth of gift cards issued, and the business had a value that was less than that, right? And so what the sellers were arguing is they were arguing, hey, um, for every $100 service out there, when that person comes in, it only costs between $30 and $40 to serve the customer. So if there's $900,000 worth of gift cards out there, we'll give you a discount on the value of the business, but we're only going to knock off like 40% of the value of the gift cards outstanding, right? So what's wrong with that argument? Um, the argument is wrong because what is happening is the seller is pocketing the gross margin of all future sales that are paid for with gift cards. So when you pay, in this example, 2.3 times SDE for the business, you are paying for the cash flow earning potential of the business. And so if those gift card holders come in and they pay with gift cards, but you've only gotten 30 or 40% of the value of the gift card, then the entire gross margin of that sale in the future has now gone to the seller instead of into your pocket. So if they get the benefit of your future activity, why are you paying them 2.3 times SDE, right? So it doesn't make sense. Another argument that I've heard, again, in a case like this with a high amount of gift cards that were sold, is the gift card float is always constant. So people will say, hey, we have always had about $1 million worth of gift cards outstanding. And every year we sell more gift cards and every year gift cards are redeemed, but the float is constant, which means that if we sell this business and we do no adjustment for the gift cards, from a cash flow point of view, the buyer is going to be okay because the same amount of cash is coming in and out. Well, what's the problem with that? The problem with that is that we don't know if that trend will continue into the future. If there's a recession, maybe people go digging through their couches looking for a loose change and empty and old gift cards that they can redeem to try to save money, right? Redemptions could increase, sales of gift cards could go down. What if you have to close a location, right? Um, if you're an honorable business person and you're going to close a location, you would inform the public and you would let them know. In fact, I know of a business that burned down and there were lots of gift cards outstanding. And what the business owner did is they rented a kiosk in a local shopping mall for a week and they advertised on the radio for people with gift cards to come to the shopping mall and they redeemed the gift cards for cash, right? Because they weren't going to rebuild the business. They got their insurance check. And so they knew we owe this money to the public. Did everyone show up for a refund? No. There was a difference. But at least they made an effort to come good on what they owed the public. Counter that to some of the other examples you've probably heard about through the horror stories of small business. So I also know of another business. It was a beauty salon, hair salon kind of place where the owner was struggling. We're going to talk about struggling business here in a minute. The owner was struggling, and so they did a big push for gift card sales in December around Christmas time. And then in February, they went out of business, right? They closed with all those gift cards outstanding. That's not a good way to go, right? So even though the float remains constant, there is eventually going to be some kind of reckoning or wind up at some point in the future. It's either going to be slowly over time, where people will redeem more than they buy, or you're going to have a business closure, or you're going to have to accept or redeem or deal with the gift cards in one shape, form, or another, right? Um, especially if you want to have any kind of future in the community, right? So don't buy the argument about the everlasting float. Another situation that I've come across with gift cards was a business that sold gift cards through other retailers. So this was kind of interesting because they had a very high gross margin. And so what they would do is they would, for example, sell $100 gift cards at another retailer and they would sell them to the other retailer for $80. So they would give the other retailer a margin, a percentage, and their cost was about 50% their gross profit. So you'd go into their business to buy something for $100, their cost was about 50. So their thinking is or was that if they sold gift cards through other people and gave them 20 bucks, that they would still earn 30 bucks when the gift cards were redeemed, right? So um, when it came time to do the settlement of that business's gift card sales, the conversation was around two things. It was around the fact that they had an expense that they had already recorded related to the sale of the gift cards. Okay, because when the gift cards were sold and the other merchant earned $20, they recorded it as an expense for selling gift cards of $20. So the liability was still 100, but they had literally paid $20 to someone to sell it for them. So they naturally wanted that 20% adjustment to the gift card liability. And then they also wanted an adjustment for the shrinkage. And so this was a great argument. And in thinking about all this stuff, when the buyer came to look at it, they were like, yeah, okay, I understand this. You actually are out of pocket 20 bucks for each one of these that was sold through another merchant. And then there's a shrinkage factor. So they came to an agreement where I think they shaved 35% off of the outstanding gift card balance. Um, Another example, for example, would be what if the business had losses? So, for example, in 2020 and 2021, a lot of small businesses had a really hard time with mandated shutdowns and public health measures and all that kind of thing. So you could have a business that had losses for a couple of years that managed to survive through selling gift cards, and they brought in extra cash, and they lost money for a couple of years, and now they have recovered and so they're making money. So now the business maybe has a value and you might want to buy the business, but there is no pot of gold. There is no pot of gold in the background um, for the seller to walk away with. So if you think about that kind of scenario, there could be $1 million worth of gift cards outstanding, but the business only has a couple $100,000 worth of cash. And let's say the business is only worth $800,000. Quite literally, you might say, hey, um, like I will accept the $1 million worth of gift card liability, uh, and you just give me the business. And that would be a fair deal because you're by accepting $1 million gift card liability, let's say only 800,000 is redeemed, you're going to put out $800,000 worth of services over some period of time for an $800,000 business. But most sellers won't accept that because in their mind, they're thinking, I'm selling my business, where's my money? Right? Not realizing that the gift card liability is just like any other debt. If they owed the bank $800,000 and or $1 million and they had the business up for sale for $800,000, they would realize pretty quickly, I can't cover my debts by selling the business. And so that person is in a situation where, because of their liabilities, um, they're not going to be able to cover it off. It's not worth anything to them to sell the business. But for some reason, when people think about gift cards, they think somehow that this debt is different in some way than owing the bank money, just because it's owed to the public rather than owed to a bank. And as a buyer or a seller, you've got to think about this debt as though it's a liability just like any other, because it's got to be repaid. And if the liability is going to transfer to the buyer of the business, it has to be repaid by the buyer. All the other stuff I mentioned about shrinkage and is there a cost, were commissions paid to other people? All that stuff has to be taken into account in the conversation. Just don't fall into the trap of accepting a gift card liability without some kind of adequate compensation. Um, and in the example I just gave, this is an idea I just had right now. In the example I just gave, if you were going to take over $1 million of gift card liability for a business worth $800,000, then those gift cards could all be redeemed in a very short period of time. And so that would be like buying a business on a 2 or 3 year amortized loan. Most businesses wouldn't be able to survive that because it would be, it'd be too much of you'd be putting out too many costs and expenses in exchange for redeeming these debts. It wouldn't be cash coming through the door. You would have to have some kind of plan or reasonable understanding that you would either be able to sell gift cards, again, extending the float period over the course of that period of time, or that you would be able to grow or generate cash from some other aspect. So, for example, I gave this example before, the massage place that has $139 massages, but all of the gift cards are $100. At least when every gift card gets redeemed, there's some amount of cash crossing the table that can help smooth that out. Anyway, cash flow forecast is the way to analyze the potential risks based on redemptions. And if you want to learn more about cash flow forecasting, head over to bizplanschool.com. That's where you can learn about my cash flow forecasting and business plan writing program. Otherwise, I hope you enjoyed this conversation about gift cards and it's made you think about things in new and different ways. And if you have a scenario or you've come across a gift card issue in a business transaction or dealing or negotiation, please comment down below. I'd love to see those comments. And if you know anyone who's looking to buy a business in any of the industries that in which gift cards are popular, make sure that they see this video. You might be saving them from a lot of heartache and trouble. And with that, I'll say see you later. We'll chat next time. Cheers.
So, how can you learn more about buying, selling, financing, and managing small and medium sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I've prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.